Ladies and gentlemen, hello, and welcome to this afternoon webinar. My name is Theo, for those who don't know me yet, and I'm here to introduce you Jens for today, and he will take over, and you will learn lots and lots of valuable things from Mr. Jens. We are just waiting Jens to join us in a while, so the reason I started the webinar just 1 minute earlier is to make sure that you are all aware about a few of our trading social media channels, better to state it that way, because they're going to help you a lot in your trading learning, in your trading understanding based on the content we put out. So the first channel, it's the YouTube that I share with you the link on the chat below. Please, can you make sure can you let me know, if you don't mind, with just a quick yes, that's fine, if you received the link, if you can read the link. If not, then I will share it again. Vincenzo already replied. Thank you so much. And also the Telegram, we have here the channel that you can, from now on, you can comment, I believe, on some post we put, so it's fantastic. And also the Admiral's Global Instagram account, that you can get informations with reels and with some TikToks repost we do. If you also want, you can follow us on TikTok. It's a bit more fun and with trading education. All right, so ladies and gentlemen, that's all from me, and I would like to welcome at this stage Mr. Jens Klatt. Jens, how are you? It's our pleasure and privilege to introduce you to this webinar this afternoon, Friday.
Hello, Theo. Thanks for having me. Yeah, today I'm very happy to be here. So I think after yesterday, especially, many attendees here will have seen what the inflation data delivered, and the good thing is that this has the reaction in the market is a direct consequence out of the FED we will have a look at today, and the ECB in addition, and hopefully formulate some interesting trading plans for the upcoming weeks and build something out of these fantastic developments over the last days. So
I will
let me just no, please move on, because I wanted to say hello in the chat, but therefore you need to give me the permission.
Yes, just make sure you can share your screen so I can close mine.
So where you see a hello now, you can now see the chance, or you have the chance to ask all your questions.
I wish you a great webinar, and
thank you, and have a nice weekend, by the way. So it's Friday, so
thank you so much.
Enjoy yourself. Talk to you soon, Theo.
Thank you. Bye.
So what we want to look at today is in fact what to make out of the FED and the ECB rate decisions. So the recent rate decisions you've probably witnessed, and last week we had the FED, the week before we had the European Central Bank. We already provided some clues, especially around the last events we had. Last week we had the non-farm payroll, so we already digged into the FED. But today, or respectively yesterday, we had a we had a news release around the inflation data, which is now giving us a better view on how to interpret, or how the market interprets the Fed last week. Probably remember that Fed Chairman Powell came out quite hawkish at one point. Wait, let me just take these out. Came off quite hawkish at one point, and this is now seeing a significant turnaround, and you saw potentially the explosion in the S&P 500 and the Nasdaq, and this is a direct result out of the rhetoric which was used from Powell, and it's potentially now the clear sign which was sent from inflation and a potential peak out we've seen here for not just the year-end rally, but potentially that we found the bottom for the year 2022. Why this is exactly where we want to have a look at this. But it's not just the FED we want to focus on today, but also on the ECB. You probably have also seen the DAX and the recent performance here, and probably have wondered how come that especially the DAX with the German industry being under massive pressure following the sanctions, which are massively backfiring against Russia. And in regards to the war in the Ukraine, why the DAX is right now outperforming, especially US equities here. And probably the ECB decision has also something to do with that, especially, I think, in fact, besides some also macro stuff we want to cover here. So before we start, please make sure that you understand all risks involved when it comes to trading, especially leverage products like CFDs and FX products. If we will formulate any game plans, trade setups, hypotheses here, please make sure that if you plan to take a trade based on these are only my thoughts, it's purely educational, but if you take any trades based on them, that you're fully aware of the risks, and that all the risks involved in these trades, you are the one responsible for them. So please make sure that you carefully read the risk disclaimer. Please understand everything here, not as financial advice, but as educational purpose only, how to interpret especially fundamental data then in this context. I don't think that I need to give admirals another introduction. I think Theo already covered this quite nicely. Check out admiralmarkets.com for further information on admirals as the broker behind these webinars, making all this possible. And so in fact, that's already it. What we want to do now is we want to jump here into the charts respectively. What we also want to do is we want to shine a light on the most recent, very dramatic to some extent, outbreak here you've seen in EURUSD. So right now you can see a massive acceleration back above parity, now heading above 103. Beside of that, let me just check where's gold right now. Yeah, no big surprise here. Gold also with a massive breakout above 1,730 USD. And how come? So what's the driver behind this? It's in fact a macro driver. So it's not a technical reaction. Besides that, certainly you can also, or you were able to draw some pictures, let's say, here over the course of the last week, especially after the non-farm payrolls. We've seen a very strong reaction. So already US dollar, the greenback under pressure. In gold, for example, we saw then here this consolidation, this bull flag forming, and that was right below a breakout level. So from a technical perspective, you could have formulated a hypothesis. We've seen already a breakout here above 1680, yeah, on Tuesday. And by the way, that was a trade I took, in fact. So I had a buy stop here at 168. I think 681, yeah, 681, and was filled, and then closed the position with a direct move above that. In fact, I didn't expect it to happen before the inflation data. Yesterday, inflation data came out. We saw another consolidation. You can see that here. Was very, very similar, with another bull flag forming, another potential projected target. Let me just move this here. Another potential target, projected target, measured move, however you call this. By the way, I now have to click, do this, and then take this one out. So we have here this move higher, then we can project the target higher, and we can see that we are now a little extended on the upside. So project the target on the upside. What you usually do is you have the first drive higher, the bull flag, and then you take the second leg higher here in this context. But this is just purely technical speaking and how to trade such an environment. But the driver behind this development here can certainly be found in the macro drivers, in this case in the ECB, respectively in the FED. What we want to do now is we first of all want to have a look at yesterday's inflation data. Put them in perspective of the recent FED decision, what the FED delivered, why that was of importance, why the inflation had an impact as it had on the market, why the market reacted as it reacted. And then in addition to that, we also want to point to the ECB and why, for example, here, I think we should be really careful now to trade, especially such extended moves on the upside in EURUSD, because the overall picture for the euro is still not very positive. And I could imagine that this momentum we can currently see here will stall rather sooner or later. And also here, if you put an keep an eye, or not just keep an eye, but if you view the actions of the FED and of the ECB, you will quite soon find out that in fact right here you probably have an attractive area risk reward wise for short, in fact, in the US dollar, even though I think we could have seen a bottom already, but still I think the euro will underperform the US dollar significantly over the course of the next 12 months especially. But well, first of all, let's have a look here at the FED. So what I did is, in fact, I haven't prepared any slides, but I have prepared my tweets around the FED from last week. So if you're interested, you can follow me on Twitter at Jens Klatt FX. This is my Twitter handle. If you're interested, just give me a follow there. I'm not yet verified, so you won't see a blue check mark. You've probably seen these ridiculous discussions currently taking place after Elon Musk took over. But we want to focus on the FED. First of all, what did the FED deliver? The FED delivered as expected, and as you probably already may know, based on what we made a topic here last week in the non-farm payroll. So the FED hiked by 75 basis points, target rate now at 375, 400 basis points. And what's very interesting is that there was an, you can see, is it here? No, it's not here. Let me just see. No, so there's no mentioning of the 50 basis points, which will now come from December onwards. No, nothing. Okay, fair enough. So the thing is, these are the comments, they hint towards this, in fact. So we have seen, there's a tool we usually use to see what to expect from the FED. It's the so-called FED Watch tool. It's for free, it's from the CME, and based on what future markets expect, you see here columns in terms of the likelihood of the next steps the FED will make at the next monetary policy meeting, in this case December, but also beyond that, so when we project that in the future. So this is very important because we now have to see what, especially in the first half of 2023, will be delivered, or is expected what the FED will deliver. Probably that's a better way to put it. If you look at, let me just see, can we still see that here? Yeah, to some extent. To some extent. In fact, so here is what we've seen yesterday in terms of the probability. Here's 1 week and here's 1 month. The thing is, why I wonder about this is that before the FED last week, there was an expectation among market participants, or there was speculation. It was kind of a, let's say, coin flip. So market participants said, well, 50% we expect the FED to hike in December after 75 basis points now in November, which was already a done deal, in fact, after the inflation, which was released 1 month ago, in fact, and also the employment situation and all that. We expect the FED to hike rates by 50 basis points in December. That's a 50% chance. And the other 50% of market participants said, well, I think, or we think, they will deliver another 75 basis point rate hike. So the interesting thing now was that the FED not just delivered as expected 75 basis points, but in addition to that, also quite clearly communicated, we see now a slowdown. So this is something you can see here. The time for slower hikes may come as soon as December. That's how you interpret the words from Fed Chairman Powell here in this context. So Powell says slower hikes may come as soon as December, which means 75 basis points. You might expect that, but no. We see the chance of where we should start to price in a chance of a 50 basis point rate hike. Let's just here have a look at the chart and the reaction we've seen. For example, let's have a look here at EURUSD and what happened there. So I will go over to the FED decision, and as you can see here, there was an immediate spike on the upside. And then after that spike higher, we sold off quite aggressively, pushing as low as 97 around, significantly below parity back again. So The reaction here was because the market saw the chance of slower rate hikes to come. So it priced in quite aggressively a more restrictive monetary policy approach from the Fed. And now the market started to price this out because the Fed clearly communicated, yes, slower hikes might come. There was also the rhetoric being used from Powell. Yes, 50 basis points from here. But then you see the market selling off. Why is that? Or where does this move come from? Well, because after the dust settled, after the initial reaction, there was a journalist asking a question, respectively asking a question towards Jay Powell, respectively making a comment and saying, hey, Mr. Powell, the market reacted bullish on your stance here, on your rhetoric. And then the camera switched over to Powell, and you could clearly see in his face, he didn't like that at all. So it's not the question he didn't like, or the journalist, but what the market made out of this. So he has no app. He was checking how is the market reacting to my comments, but it was more like you had a clear reaction, like, I don't like this at all, that the market is reacting bullish on these remarks and what I just said, which respectively what the Fed delivered. And why is that? Well, because the target of the Fed is to bring down inflation. Simply speaking, if you have a bullish reaction in equities, and we've seen that the market already sold off quite heavily over the course of the last months here, you can clearly spot this. So this is a bear market. We topped out at the beginning of this year around 16,600 points, and then we bottomed something like 6,000 points lower, which means the market corrected more than 30% within the span of 9 months. So it's a clear bear market in case of tech stocks, similar in the S&P 500 we've seen here. And why is it so important to bring down equity prices? Well, because to dampen inflation expectations, because if people, simply speaking, very roughly speaking, if people feel rich, you buy stocks, let's say you bought them for whatever reason, because your stimulus checks arrived around the COVID pandemic, lockdown, whatever, and you say, well, I spent the money and some of my savings buying some tech stocks, and then you see the market accelerating from here and nearly, it's not tripling, but it's more than doubling within a span of 1.5 years, you feel richer than you felt before. And exactly that means you're consuming more. And if you consume more, if you go out and buy stuff, the money which is flowing around, let's say, there's more money chasing goods. And the richer you feel, the more you chase, and the more you're willing to pay a higher price. If you now see equities coming down that significantly, people don't feel rich anymore, but people start to worry about the future, and they're fearful. They are not that optimistic. So that, I mean, again, it's very roughly speaking, but this is how you can imagine the psychology behind what we've seen here. If now the market reacts bullish to the stance from Powell, and we're only talking about a small bullish reaction, it wasn't something significant. This is not what you want to see if you want to bring down inflation, or if you started to see a peak out over the course of the last months, you see some acceleration on the downside, but somehow now the market is again seeing a more dovish stance in the near future, markets starting to bottoming out and taking off from there. What did this result in? Well, the next comment from Fed Powell on this remark, which was, by the way, wrong at this time, because you can, again, let's come back here to the 50-minute chart. First reaction, we've seen that already in the euro, but you can also clearly spot this here in the chart. You saw the spike higher, but then we rolled over. And this was the region around 11,100, something like that. This is when the remark from Powell hit the wire, which we'll see in a few seconds here. That was when we accelerated aggressively downwards. So the journalist was focusing on what happened 10, 15 minutes ago, where he might have been right that the market reacted positively, but the market had already sold off this initial pop on the upside again. So, and that being said, then it resulted in this acceleration here on the downside. And so what exactly did Powell say? Well, let's have a look here. He said, the ultimate level of rates will be higher than previously expected. What does this mean? again, coming back to the Fed watch tool here, if you carefully watch the developments, so it's not that you just look at this and see how things are right now, but it makes also sense to give this, especially in the current environment, once or twice a week, a deeper look here. And you could have seen that we had an expectation among market participants that the Fed pivot, let's say, or the highest rate level, the target rate is in fact around 500 basis points. That's something you could have seen here in the Fed watch tool, but in fact, you don't really need the Fed watch tool. You just need to check the so-called Fed dot plot the last time, which it was released in September. So you probably remember that's also something which is completely available for free. It's a so-called summary of economic projections. It's published each quarter, March, June, September, and next time in December. And if you scroll down a little, I think page 4 or something, you see these dots here. And some people might say, well, this looks a little pathologic. In fact, it's very interesting because it's for each dot you can see here, you see an FOMC member and where this FOMC member sees the rates in the future. In this case, over the course of the year 2023, for example, 2024, and so on and so forth. And if you carefully watch, you can see that the highest dots here can be found between 475 to 500 basis points. So in fact, they are slightly lower. So the majority of these can be found here at 450 to 475, in fact, slightly below that level. The market already priced in a more hawkish stance because they were not seeing inflation coming aggressively lower, and thus justifying a more dovish approach from the Fed. But you could see that here. So this is what the Fed members at the end of 2023 expect the market to do, or expect the Fed to do in terms of the rate level and where we will stand at the end of the year. Certainly, it could be that we see in the first half of the year some kind of a more restrictive approach to dampen inflation. Then we see a rollover and dig into a recession here. And from there, then we see the necessity of, let's say, rate cuts in the second half of the year, probably. But all in all, we can say we never saw a rate level here above 5%. That in mind, and something which Powell was certainly aware of, and if you look here at this comment, ultimate level of rates will be higher than previously expected, means nothing more than we will be more restrictive. Yes, coming back here, slower hikes may come, but they will last longer than you expected. Which means, like, if we say 75, then next time in December we have 50 basis points, and then probably one further 50 basis point rate hike. Now we're talking about 2 further minimum. And this is exactly what drove equities, but also US dollar stronger, gold lower, equities lower, and so on and so forth. And if you keep this in mind now, well, the thing is that the market is now expecting the Fed to be more restrictive in the future, which makes perfectly sense based on the comments from the Fed chairman. But the key event now is the inflation, because if the inflation numbers, which were expected to come in at 8% yesterday, come in significantly below that level, and inflation cools down, and inflation is what the Fed is targeting here and aiming to bring back under control, then that means that there's more room for more, let's call it dovish, or let's say more expansive monetary policy path you can follow. That means, and they've seen it yesterday, so this is trading economics. We will here come in United States countries, and then we'll click on inflation rate. You have yesterday 7.7, expectation was 8%, significantly below that level. Well, after the market participants, especially in the first half of the year, priced in 550 basis points here, resulting out of the Powell comments, then they are now pricing this out again. So now they say, well, yes, he might have said this, but he wasn't aware of inflation data, which now came in significantly below expectations. So yes, the ultimate level might be higher, but why? Let's put it here. Why should the ultimate level be significantly higher if inflation comes back down to, let's say, 5.5% already earlier than initially anticipated? That doesn't make sense. So that being said means that the dot plot we see here in December will likely remain the same. Probably these dots will in fact being lowered from the FOMC members because they say, well, we don't really need to have a more restrictive policy approach, monetary policy approach, because now the other side of the coin comes in and plays a role. Well, what we see here is rising fears around the recession in the US because of a restrictive monetary policy approach. Now we have to make sure that we are not killing our economy. Thus, we will be more loose in our monetary policy approach. And this is exactly what we got to see here in case of yesterday, and why the market exploded on the upside. So in fact, what we could certainly see here in this context is that when we started, let's come back to, that's a 30-minute chart probably. When we started here, this rally yesterday, so we now made it above the FED level. So we cleared these levels yesterday. You can find this around 11,300, 400 points, something around this. And we now cleared this level. And because now the market has the final conviction that, yes, there were the comments from Powell, but probably most likely just did it to bring equities lower, or to talk them down, let's say, which is surprising, no question about that. But now we are in an environment in which we have a clear conviction that inflation has finally peaked and will continue to drop further. Why, by the way? Why should we expect this in fact to happen? There's something, that's why I use trading economics. By the way, before I do this, I have to just type in some data for my preparation for the US market opening. Today is a very interesting day. In fact, after the dust has settled, but also with the picture we've seen, or we see currently developing, especially in stocks like Tesla, but also Coin, for example, based on the crypto developments and the meltdown there. And I have to prepare my sheet here. You probably recall this. That's the sheet. Oh, we already dropped 50 in Coin. If we can't make it back, then I think we are potentially selling out again. I have to fill in these information to have a chance, if I take a trade, to review it accordingly and write it down in my trading journal. So, but let's come now to inflation and why it potentially sees some further acceleration on the downside. I in fact expected. I didn't expect it. Inflation to come in at 7.7, but I expected it to come in below 8%. And the reason for that, if you asked me, I would have shown you the following. So you have a chance here to compare the chart. So this is inflation, the columns of the last 12 months. And if you click on compare and pick country, you can type in United States and, oh, I'm sorry. No, let's put it differently. This is not a good way to put it. I go the other way around. In fact, we start because it's a subcomponent. I don't know whether it's available within this column. So first of all, we go here to business indicators, US business. There you have business confidence. This is in fact the ISM manufacturing. And you're probably aware of the fact that these ISM or purchase manager indices here in this case, they have subcomponents. And one of the subcomponents is paid prices. And you can already see that paid prices, which are definitely positively correlated towards the inflation, for a clear reason that prices, if they rise, that's something, if as it in price, then it drives inflation higher and vice versa. You can see clearly that there's a top out taking place. And if you now go to compare and compare this to the inflation rate, what you will see, United States inflation, what you will see is that the blue line is, or the black line is trailing the blue line. The blue line is the paid prices ISM component, while the black line, the black dotted line, is the inflation rate. And you can see that, again, we already rolled over and see a significant drop in paid prices here in manufacturing sector. The same is true for non-manufacturing services and so on and so forth. So what you expect rather sooner than later to happen is that inflation will drop significantly lower also. And that having that in mind now leaves us come to the conclusion that if inflation has finally peaked, well, then the market is expecting a more dovish stance from the Fed. And in fact, this is now also adding fuel to all data sets which will be released in the upcoming weeks. In fact, so next time we will have a live event around a news release will be around the non-farm payrolls at the beginning of December, for example. And that, having in mind, means if employment situation also worsens and you see a spike higher, this is also something which is very likely. Look at the most recent developments around Meta/Facebook, for example, laying off, I think, 11,000 workers. There was a clear impulse being sent from Elon Musk after his Twitter takeover, firing, I think, half of the staff. And all social media companies, especially, but also in the non-manufacturing service sector, you see a significant wave of layoffs now taking place, which means chances are high that you will see an uptick also in the employment rate, or respectively unemployment rate in this case, which means you see a clear darkening outlook for the overall US economy, in addition to a cooling inflation. And that means there is more room and also necessity from the Fed to deliver more liquidity to the market. Well, what does this mean? It means that equity prices should expect to trade higher. Let me just, by the way, have a look here. Okay. That equity prices will potentially trade higher after this significant breakout in case of the NASDAQ then, for example. So, which is especially true, there's then the technical setup, which could also deliver some further upside potential and the year-end rally if we can clear and hold above the October highs. Today is interesting, by the way. So if we can do this already today, let's see if we can let's say save most of the gains from yesterday, probably see follow up on the downside, on the upside, and holding above this red dotted line here around 11,600, 11,700 points. If we can hold this level, then I think there's further room on the upside in equities, in this case in the NASDAQ, given what the Fed just delivered. The same is true for EURUSD, even though I have to say again, we are very extended now on the upside. And I think given what the ECB delivered 1.5 weeks earlier, no, not really, 1 week earlier, we clearly have to say, well, that's probably even more dovish, and it's very difficult to see that this is a sustainable move higher. So I'm not saying that in case of the EURUSD, we will now significantly drop further, break parity again and trade to 95 again, respectively 90. But I think that we will see a trading range around parity. I don't think that we are about to see a trend now forming with a bearish tendency in the euro as long, and therefore I will just here bring in the 200 moving average, simple moving average. So as long as we trade here below the 200 SMA, which currently can be found below 105. So meaning I could imagine that will be a quite volatile development, but we will trade around parity with the low at 95 and the high at 105. Bringing us in fact to the ECB and the question, what did the ECB deliver, or what did the ECB not deliver? Therefore, I have here the CNBC CNBC article around this. But wait, let me just check. Okay, very interesting, because here you see the headline and coin, why it's potentially in play today. Coinbase, you can see Sam Bankman-Fried, the CEO of FTX.com, just stepped down as CEO as his crypto exchange files for bankruptcy. So no big surprise here, but this could now result in a fire sale, bringing potentially Bitcoin under pressure. That's one of the reasons why I don't want to give Bitcoin a deeper outlook today, because there's a different driver behind this, and it's not very related to what the Fed especially delivered. But let's have a look here at the ECB. So delivers rate hike of 75 basis points. I can already say, and you can read this here within this article, there's further room for further rate hikes, but there might already be clear signs of a slowdown here too. So in fact, the ECB delivered 75 basis points, but also clearly communicated that now they will view the upcoming rate decision step by step, we say, or from meeting to meeting. What does meeting to meeting in this context mean? Well, it means that we have a very good chance that there's no further rate hike or a lower than expected rate hike from the ECB, if we can also spot these developments in terms of inflation in the Eurozone. Coming back here, we go to countries and then to the euro area, and then we can do the same. Look at the inflation rate, which is above 10%. You can see that here, clear acceleration on the upside. Also here, the question is, can we spot some signals in terms of a potential rollover? As of now, I don't think so, because and the reason I say that is because therefore, especially if you see or understand that the main driver for inflation, or at least this is my personal opinion, but something which I could certainly argue if I had to, the main driver is in this case, electricity prices, energy prices, and the fact that the euro dropped significantly. And since you pay your energy in USD and the reserve currency, world reserve currency, well, you import inflation in this case. So with this escalation on the upside, we've seen there energy prices, electricity prices. Well, we certainly saw also a clear acceleration in prices here and in terms of the inflation rate. Now, the thing is that these prices have significantly dropped already, which means there might be a peak rather sooner than later. We come potentially down quite aggressively, similar to what we've seen in the US. And this means that coming here to the ECB rate decision and the communication and the rhetoric being used from Ms. Lagarde at the press conference, that she, or respectively the ECB, won't deliver a more restrictive policy path in the near term, which is also understandable, since if you are too restrictive, given the overall developments in the yields, in the yield world, or let's say in Italian yields, southern periphery states and their yields, you can't be too restrictive if you don't want to risk to bankrupt these countries, especially Italy in this case, given their very high GDP or debt to GDP ratio, in this case from, I think, around 160%. So similar or close to what we've seen in Greece, with a big difference that in case of Italy, we're talking about the third biggest economy in the Eurozone. So coming now to the ECB and their stance, this is something to keep an eye on and to keep in mind. Right now, I don't think that this drive higher here and this push higher, the main driver here behind this is euro strength, but in fact, US dollar weakness, respectively, a corrective move we could have seen coming after the near parabolic move in the first 6 months of the year 2022. In fact, by the way, when talking about energy prices and electricity prices, there's also, if we look here at the DAX, there's an explanation why the DAX took off that aggressively, compared, and especially here made it significantly back above the highs from the Fed already before the inflation, while the S&P, for example, here, while the S&P had some trouble making back these, let's call them power losses or Fed losses, and took off then after yesterday and took out these highs here. So I think one main driver for this move higher here is that there were not just projections from the economy-wise, that high electricity prices and energy prices are potentially driving Europe, and not just Europe, but especially Germany, the biggest European economy in this case, into a recession, a deep recession. They projected these targets, these price levels, energy and electricity prices, into the next year, and thus coming to the conclusion that we will see a deep recession in Germany. In addition to a quite restrictive monetary policy approach. Now we see the ECB saying, yes, we are more restrictive to get inflation under control, but, well, we have some room. Let's see. I mean, well, probably we will top out earlier, see a peak there, and don't need to be that restrictive. So we will see this from meeting to meeting. This is already quite dovish in itself. But now, in addition to that, we also can see that we have signs which are showing that there might not be a recession as deep as projected, probably not a recession at all. Probably we see some small economic growth in 2023. So this combination is potentially the main driver for the DAX higher in this context. And here now, after pushing us above these highs here from August, potentially activating a target on the upside around 14,600 points. We are still underwater for 2022 here, and I still prefer US stocks over European ones. But most recently, and given the last, let's say 2 months, well, probably 1 month, the last month especially, the DAX has significantly outperformed, and potentially because this was the main driver. So to shorten things up, let's say the main reason, the main driver right now is certainly what we've seen in terms of developments and the monetary policy approach, especially Fed-wise, but also ECB-wise. I see a more or looser, let's say, monetary policy path ahead. With the Fed, especially if we now saw a peak out in inflation and a acceleration on the downside, or deceleration of inflation in this case, which is then most likely, I think, and very likely, in fact, very likely resulting in a looser monetary policy approach, which is driving US dollar lower, while driving equity prices higher. But I already said EURUSD, well, do you really want to be long EURUSD here because of the, let's say, not that great potential on the upside? It's not just that the monetary policy approach from the ECB is quite loose compared to the Fed. In fact, if you compare the rate levels, but in addition to that, look at Europe from a political landscape. I mean, especially here in Germany, I'm just shaking my head in disbelief if I listen to these guys. This is unbelievable. Sometimes, yeah, well, really. And I talked to several people around the globe, in fact. So I'm in a very fortunate situation to not be concentrated in Germany, but have many business partners around the globe. And there's many people out there shaking their heads in disbelief about the German policy in this case, and politicians here and their decisions over the course of the last months, in fact. And why Germany a topic? Well, this is the biggest economy of Europe. So in fact, I break it down to saying, well, Germany and the health or not health of the German economy, besides where is the what's the word for this? Decides about the future of the euro. Let's put it that way. And thus, I'm not very optimistic on the euro in general. And I don't really, even if I see the US dollar under pressure, I don't want to be long the euro, to be honest. And well, if I'm short for the US dollar, well, you have a perfect hedge with gold in this case. So even though trading wise, that was quite difficult. And no, it was a great week for traders, let's say, gold wise, because the action here was quite difficult sometimes, and was very, very difficult to trade these patterns, especially for me. But as a breakout trader in this case, with these patterns forming here and this potential bull flags here forming, you had some very significant and strong moves. But also now, from a longer term perspective, I think there's a clear sign that we bottomed out. And especially now with this trend line, we broke this trend line, we broke above these highs here from October. And if we hold now 1,730, in addition with this looser monetary policy approach, we should expect from the Fed in the months to come. And the next guide again is the economic projections and the dot plot again. So let's see what they deliver, but we will get a clear picture. And I already have something in mind I want to see here, based on what I got right now, and then to formulate a bull case in this case for gold. So I could really well imagine that we are about to see at least the first attempt to recapture 1,800. Let's bring in here this 200 simple moving average 2, which you can see here comes in around quite clearly at 1,800. So this is a key level. If we make it above that level, if we can hold that level, then I think this is then giving us further upside, up to 1,900 USD probably, depending certainly a little on how the US dollar develops. In fact, if the US dollar sees a corrective move, I'm not really willing again to trade the euro again long against the USD. I think that the euro is capped around 105. Probably pound sterling is a good choice. Not really the JPY, but probably pound sterling is an interesting candidate, even though I haven't prepared something on pound sterling right here, so I haven't even the chart open. In fact, I'd prefer gold here, especially if we hold 1730, and if we see now conviction or let's say clear sign, especially next month with the FED and the economic projections in the dot plot here. And so in fact, that's it. So summarizing things up here, all in all, the FED came in quite dovish to some extent, delivering a remark here, which says slower hikes may come. Then Powell sees market is reacting bullish to that, or at least thought it would. He comes out with ultimate level of rates will be higher. Then we get yesterday inflation rate, which comes in significantly below expectations of 8% and a clear rollover against the recent highs mid this year. So there's a potential peak out now, making it likely that the Fed has more room to navigate and be looser in her monetary policy approach in the months to come, especially if the employment situation starts to worsen, which doesn't seem that unlikely. And this is certainly something which is positive, in fact, because looser monetary policy approach should react or result in a bullish reaction in equities. And in addition to this bullish reaction, also potentially driving gold higher. And the euro, we don't like the euro that much, given what the ECB delivered. On the other hand, and in fact, that's it for my end. So if you don't have any questions, and it doesn't seem as if there are any questions, and I hope you enjoyed the webinar and you learned something, and you can take something out for your next investment and trade decisions, in fact. And that's it from my end. So have a nice weekend. Enjoy yourself. Talk to you again next week. By the way, for all those now watching the recording on YouTube, don't forget to leave a thumb up here if you liked it. If you haven't yet, please subscribe to the YouTube channel. And all the best from Germany. So see you next week. Talk to you soon. Bye-bye.